All right. I appreciate everybody getting on this morning. My name is Danny Fitzgerald. I'm the Acting Regional Director for the San Diego and Imperial Small Business Development Center Network. And we're really excited to be able to have two tax experts who were able to volunteer and come in and be able to talk a bit about the CARES Act and all the tax implications, because with all the different laws that passed earlier this year, in particular in March, there was a lot of tax implications that came along with it. So really appreciate Tarina Evinger and Bruce Knowlton from Moss Adams. Bruce, he is a tax partner at Moss Adams who provides tax services to a variety of privately held companies in the manufacturing, distribution, and real estate industries. He specializes in tax consulting with an emphasis on closely held business entities. He also provides income and estate planning for high net worth individuals and business owners. And Tarina, she is a tax senior at Moss Adams who provides tax services to clients in a variety of industries, primarily construction and real estate. She provides tax consulting services with an emphasis on closely held business entities as well, and business owners. So really appreciate Tarina and Bruce getting on. I was able to get a preview of some of this information, and it certainly was very, very helpful to me. So I'll go ahead and let Tarina and Bruce kind of take it on. If you have questions, we're only, since with the numbers of people that we have in this meeting, please place them in the chat box. I'll be monitoring those, but do kind of save them towards the end because most likely a lot of questions will be answered during the presentation. So Tarina, go ahead and take it away.
Yeah, thanks, Danny. So we're here to just talk about all the tax implications of the CARES Act. We've got a lot of stuff to talk about here, but I'll try to go kind of quickly so that we can leave plenty of time for your guys' questions at the end. We have this lovely little disclosure that we always like to add. Just our information is pretty general, so make sure to consult any tax advisors before you take this information and apply it for yourself. Bruce, Danny already kind of gave a good introduction, but did you want to add anything?
No, I think you and I have been through a number of these, so this is pretty easy now, sort of. We're still kind of, both you and I, focused on the PPP program, which is not part of today's presentation, but if we have time at the end, we can kind of update things there. And I've been in this business now for over 30 years. I don't want to say exactly how old, so people can't totally know my age. But Tarina, why don't you introduce yourself a little more?
Yeah, I have been in this industry much less time than Bruce. He's much more knowledgeable than I am, but happy to be here and participate with him in this presentation and help you guys understand all of these tax issues. All right, so let's dive in. Retirement fund provisions. The maximum distribution that you can take through the end of the year is $100,000. This can be taken for anyone that has coronavirus related issues. So this can be, being sick or having financial consequences from reduced work hours or being laid off or furloughed. And if you take up to the $100,000 distributions for these coronavirus issues, you can get the 10% early withdrawal penalty waived. So you may still have to include those distributions in your income, but you won't have to pay the penalty that is typically applied for early distributions. So that income, say you take the full $100,000, that income of the $100,000 can be spread over 3 years. You don't have to pick it up all in your 2020 tax return. But there's also this provision that says if you recontribute the amount that you distributed within those 3 years, you won't have to pick it up as income. They also increased the maximum loan amount to $100,000. This was typically $50,000, I believe. And the repayment rules have been extended 1 year. You also don't have to have required minimum distributions for 2020. So if you typically have those, that is something that you can forgo this year, which could help your 2020 tax rates.
One comment, not that it really matters too much, but this actually came out of the Secure Act, which was passed right before the end of last year. It's not really part of the CARES Act, but and then there's another act that will be into called the Family First Coronavirus Response Act, which has some tax information that Trina will go over as well. So it's really a combination of 3 acts. The main one is the CARES Act.
Yeah, thanks, Chris. Charitable contributions. So typically you cannot deduct charitable contributions unless you itemize deductions on your tax return. But for 2020, they're allowing up to $300 contributions to be deductible, even if you don't itemize. You also can contribute up to 100% of your adjusted gross income for the year. So typically this is limited to 30 to 50% depending on the contributions. Actually, I think it's 60% now, isn't it, Bruce?
Yeah, that's right.
But so for 2020, you can contribute up to 100% to just promote charitable contributions during this time. Just to note that these contributions do have to be 509c3 charitable organizations. They cannot be 509A3 contributions. Those are to supporting organizations that don't have as strict regulations, and so they just want to make sure that the contributions are going to those organizations that actually have more strict regulations. NOL carrybacks. Net operating losses used to be, before tax reform last year, they used to be allowed a 2-year carryback for individuals and then a 20-year carry forward. And tax reform got rid of that and said you cannot carry back your net operating losses at all, and they can only go forward. So then the CARES Act came and said any NOLs that are arising during 2018, 2019, or 2020 can actually get a carryback, and it's increased up to 5 years. So you can go back to your 2018 return, and if you had NOLs, you can actually now carry back those NOLs to 2013 and then forward from there. If you do have 965A income during any of those years, which relates to foreign income, it's the transition tax that came out of tax reform. You may have some special rules. So just note that if you have those foreign income inclusions, that you may have to look into some further rules for that. Tax reform also limited your NOL carryovers and how you can use those. So if you had a net operating loss in 1 year, that carried over to the next year, you could only use up to 80% of that carryover. But the CARES Act came out and suspended that rule until the end of 2020. So 2021 is when that will come back into play. So for now, any NOL carryovers can't be used 100%, assuming that you have the income to offset it. And if you have REITs or life insurance companies, just note that there are also special rules for that. So you'll have to look into that a little bit more. Bruce, I know this is a big one. Do you have anything to add?
Just a couple comments. One is the net operating loss in whichever year it occurred, 18, 19, or 20. In terms of the 5-year carryback, you get to select what year you want in that 5-year period to go back to. And so it's a little bit more targeted than the old carryback, where you had to go to the oldest year first and then roll it forward, assuming you carried back. And the other thing is, I don't work with a very many C corporations that pay their own taxes, but if you have that scenario, these same carryback provisions apply in that situation. So.
Also from tax reform was created this excess business loss issue. So if you had business losses that were in excess of $500,000, for married filing jointly, I think it's $250 if you're single, then you would be limited to that $250 or $500,000, and the excess would be converted into an NOL. So the CARES Act came and suspended this again, and this one also is retroactive to 2018. So if you had any of these excess business loss limitations last year, you can actually go back and amend your 2018 return to take those losses.
And I would just say that those losses, if they create a net operating loss, then are eligible for this prior provision of the 5-year carry back, or they can be carried forward. It's all your choice, essentially.
Yeah, absolutely. Some other provisions that apply to business owners. So again, tax reform created these 163J rules, which are limitations on interest expense for businesses. And the original rules are that your interest is limited to 30% of your adjusted taxable income. But the CARES Act came out and said that this will be increased to 50% for 2019 and 2020. What's interesting though is that partnerships are treated differently than S Corps. So for partnerships, you still actually have to use the 30% limitation, but then what happens is any excess business interest expense that flows through to your individual return that you weren't allowed to take in 2019, 50% of that will be deductible in 2020. So you're limited more this year, but you get to take 50% of that deduction. I think more of a no matter what kind of thing in 2020 when you file your taxes. And then the remaining 50% will just follow the 163J normal rules. And then for S Corps, like I said, you get that increase from the 30% limitation to the 50% limitation for 2019 and 2020. And you don't have any sort of 50% deduction in 2020. You just get that increased limitation. There's also this retail glitch, as we call it in the tax world. Qualified improvement property are typically leasehold improvements that are done to rental real estate. And there's certain qualifications that you need to meet this. But with tax reform, this was only allowed to be 39-year property. In the past, this had been 15-year property, and this is why we kind of call it a glitch. It should have still been 15-year property, but the way that tax reform was written, it was only allowed to be 39-year property. So the CARES Act came out and said it can be 15-year property, and because it is 15-year property, is now eligible for bonus depreciation. This rule is also retroactive to 2018. So if you had any qualified improvement property on your return last year that you were not allowed to take bonus on, you can go back and catch up that depreciation. Employers can now pay up to $5,250 of an employee's student debt, and this will be tax-free to the employees. So typically, if an employer makes a payment like this, the employee will have to pick it up in their W-2. But with the CARES Act, if you make these payments during 2020 up to the $5,250, it will not be taxable to the employee. Tax impact for the PPP loans. So the CARES Act said that PPP loan forgiveness is not taxable as income for federal tax purposes. But then subsequently, the IRS issued this notice that said deductions that for expenses that you use those PPP funds for will be disallowed. So there's a lot of discussions in Congress right now about this because most people believe that, us as well, believe that this was not the intent of the CARES Act. And we think that there's going to be a fix that comes out in the bills that are in discussion right now in Congress. But as of right now, the forgiveness will not be taxable income for federal purposes, but the deductions are disallowed per what the IRS says. And California has come out and said that they will not conform to federal, and any forgiveness for these PPP loans will be taxable as income. Anything to add, Bruce, that you've heard recently? I haven't heard anything.
No, we're hoping in this latest stimulus package that they're debating right now that they fix this for IRS purposes. The effect of it is that to the extent of the forgiveness, they're saying the expenses you paid to get that made you eligible for the forgiveness are not deductible. So it's kind of a tax neutral thing. Whereas if they would go with what the actual language of the bill said, it would actually be a tax favorable thing because you would have no income on the forgiveness side, but you'd still deduct the expenses that that you had to get the forgiveness in the first place. So, that was, it appears to be the intent of Congress when they pass this, and the IRS has gone another direction so far.
Yeah. Payroll tax credits that Bruce kind of mentioned in the beginning with the FFCRA. So emergency, sick, and family leave payments are required to be paid by certain employers. I believe it's certain public employers as well as private employers that have less than 500 employees. And this is available for leave paid between April of 2020 and December of 2020. So through the end of the year now. Sick leave is for anyone that is actually sick or is recommended by the doctor to stay home. And you can get up to 2 weeks pay at the employee's regular rate of pay. This is limited to about $500 a day. But then there's also this other piece within the sick leave that allows for anyone that is caring for a child or a family member that is also sick. That's more similar to the family leave, but you still get, within the sick leave portion, you still get up to 2 weeks pay, but it's 2/3 of your regular rate. And again, this is with limitations. I believe this one's up to $200 a day. And then the family leave piece is similar, but slightly different. Those first 10 days, so those first 2 weeks of work can be unpaid or be paid through, your regular PTO or the sick leave program or any other method of payment. But then after those first 10 days, you may be required to pay up to 10 weeks of family leave pay. And again, this one is 2/3 of an employee's regular rate of pay, limited to $200 per day. And the family leave one is specifically, it's the rate, 2/3 of the regular rate of pay times what they would have been working. So if that employee would have reduced hours anyways, then it's the 2/3 of regular rate times those reduced hours rather than like the total 40 hours or whatever their normal hours are before coronavirus. So with these items, if you are required to pay these leave amounts, you do get a payroll tax credit. So when you file your 941s quarterly, you can get a credit for these leave payments that you paid. And this is all based on your Social Security taxes plus healthcare, certain healthcare expenses that you can add into there.
Yeah, one comment is they made this mandatory that the employers pay this for businesses with more than 50 employees. And then
Okay.
there's an exception for those that are less than 50. So,
The employee retention credit. This one is available for any employer. You don't have to be under 500 employees, but there are requirements for being heavily impacted by the coronavirus. So the way that it looks at this is it's a quarter by quarter test that you do. And the first quarter that you have 50% or less of growth of 2019's gross receipts. So say we're looking at second quarter. If your second quarter 2020 is 50% or less of your 2019 second quarter, then you qualify for this employee retention credit. And then each subsequent quarter, you have to be less than 80%. So the subsequent quarters aren't quite as restrictive, but you still do need to be heavily impacted by the coronavirus to be able to take this credit. And this one again is for wages between April and December of 2020. And you can get 50% of qualified wages up to $10,000 per employee. So a maximum $5,000 credit per employee. I can't remember if I already said this one, but anyone that received a PPP loan, though, cannot use this credit.
I guess one thing we don't have in
yeah.
the slide that I'll just mention is there's a deferral of the employer Social Security tax, which is 6.2% employer paid, that is available whether you have a PPP loan or not.
Mm-hmm.
So you can defer paying that. I think it started in late March, right, Trina? Through the end of this year, all that amount can be deferred 50% into the end of 2021 and the other 50% in 2022, if you want to take advantage of that deferral.
Yeah, and originally there were some limitations. If you did have a PPP loan, you only got that deferral for a certain period of time, but they, with the Flexibility Act, came out and said that anyone that has a PPP loan can still get this deferral through the end of the year. So just general considerations, kind of looking over everything we just talked about. Look at any net operating losses that were generated in 2018 that you can maybe now carry back. Look for the opportunity to amend your 2018 returns if you had any excess business loss limitations that wouldn't be limited anymore. And then, like Bruce commented earlier, these may be available for carrybacks if this creates an NOL. Look for the opportunity to catch up any depreciation for qualified improvement property. So any of those leasehold improvements that qualify are now 15 years and you can take bonus depreciation on them. So that's a possible benefit for you. Actually, I'm gonna go back to that piece. The catch-up depreciation, you can go back and amend, or you can also do an accounting method change and change this. This requires a separate form, a Form 3115, but then you can change this on your current year return going forward instead of amending last year's or the 2018 return. If you have required minimum distribution for your retirement, 401k, IRA, then you can consider skipping those for 2020 if you don't need them for your finances, and then you wouldn't have to pay tax on them this year. If you do take up to those $100,000 distributions out of your retirement plan, consider repaying them over 3 years to avoid including them in your income and paying tax on those. So that's all we have for now. now it's open to you guys for questions, and hopefully we can help answer them.
All right. Thanks, Tarina. Thanks, Bruce. So I'll just kind of go through some that are here in the chat box. One from Jody is can you give an example for the IRS Notice 2020-32?
Yeah, so in other words, let's say that in your forgiveness application, you put down the wages that you paid during the covered period. The IRS notice is saying, to the extent that the SBA through the bank gives you forgiveness related to those expenses in terms of the loan, you don't get to deduct the expenses. And so, as I mentioned earlier, it ends up being kind of a tax neutral approach based on that IRS notice, as opposed to a tax favorable approach, which we believe was the intent of the law as written. So more to come on that, obviously.
Just to put numbers on that, say you have a $100,000 loan that gets forgiven because you had $100,000 of expenses. Those $100,000 of expenses just won't be deductible on your tax return.
Cool. So Charlo asked, she kind of had a statement, but I think it's good to kind of clarify this in terms of the employee retention credit versus PPP recipients and how those two interact. I mean, obviously you can't, it's an either or, but kind of elaborate as to kind of what you can see is why that exists, but also kind of elaborate a bit more on the credit versus the PPP and how those two interface.
I think the idea was that well, first of all, the PPP recipient could have no more than 500 employees, with some exceptions for franchises and restaurant chains, that kind of thing, automobile dealership franchises. Other than that, there was a 500 employee limit, whereas the ERTC is meant for businesses that decided to go ahead and keep payroll going, even though they were impacted by the coronavirus, that were very large usually. Like Starbucks comes to mind. They came out and just said, we're going to pay our people because they're concerned about the employees' health, but they have the money to pay. They want their employees to stay on the payroll, so they're picking up this credit. That was kind of the idea. Now, whether these rules will change, because they originally said, as an example, the deferral of the employer share of the payroll tax is not available once your PPP loan got forgiven. Well, they threw that out on the latest go round. So who's to say that they won't, take the same approach with the ERTC down the road? But that's at least currently our understanding is the two are mutually exclusive. For that reason, they were really targeting more larger businesses with the ERTC.
Okay. And so that kind of, you touched on it a bit there, but so how is the PPP treated, either the forgiven or the unforgiven portions, in terms of income?
Well, the unforgiven portion is definitely not income because it would turn into a loan. In terms of the forgiven amount, that our IRS is agreeing it's not taxable, but they're trying to do an end run, not to be an anti-IRS person here, but they're saying, well, but then your expenses that got you the forgiveness are no longer deductible under the kind of the theory that there's another theory out there that when you have tax-free income, like from a municipal bond or something, that you don't get to deduct the associated expenses against that income. There's a rule about that. So the IRS is saying, hey, it's the same rule applies here, but nobody said that in the CARES Act. It's just the IRS interpretation. So, yeah.
And then on the other one on that related question, then I'll come back to one that's kind of a combination one, is the up to $10,000 forgivable portion or the grant portion of EIDL, how's that treated?
We believe that's still taxable until they say otherwise. There's no element of forgiveness in any other grant program that we're aware of, and there's tons of them. That's one, EIDL, advances. There's people in the health services business, HHS, GAN's Health and Human Services grants are taxable when they're not having to be repaid. And there's also state and local county grants going on that are also, don't have to be repaid as we understand it. That's all going to be considered taxable income. Other than this PPP, which is specifically supposed to have a tax-free element to it, and the IRS is making that cloudy. So
okay. So just to kind of reiterate then, so all these grant portions, even like the ones from the city of San Diego or the county of San Diego that are coming out, that are CARES Act funded, there still would be considered taxable income because there's no repayment, correct?
Yeah. And one of the other common questions is, what about if I got funding, like if I'm a nonprofit and I got funding from a source to cover certain payroll, and then I also got this PPP loan, can I use them for those funds for the same expenses? And the answer is no, which is logical, but that's come up a lot.
So then we had a couple of questions, just kind of, we talked, a lot of the stuff you talked about has to do with businesses with employees, but what about sole proprietors, self-employed individuals, ones that don't have W-2 employees? What are is there anything in particular that you didn't touch on that's advantageous for them?
Well, their employee headcount is a lot easier, right?
Right.
If they're by themselves, owner employees don't count as far as the FTE test period or the covered period. And so therefore there can be no employee FTE reduction that could occur. I guess they still have to worry about the 75% rule, I would think. Is that your understanding?
The salary?
Yeah. If their test period was at a higher rate of self-employment income versus their covered period, I think if there's more than a set 25% drop there's probably some sort of haircut that could occur.
Probably. I guess I just haven't really seen that because most sole proprietors are paying themselves similarly to what they were last year. I think more the issue that we've seen is that if they didn't pay themselves very much in 2019, then they're limited to that 2019 pay. Or I guess not even really pay, but what they made last year, their net income.
Yeah, there's a rule though that says you have to be able to pay your employees at least 75% in terms of the test period versus the covered period, which is from loan funding. And I would think, if they put in there what their self-employment income was during the covered period and it's too low versus where it was, then they could get that haircut there. They won't have the FTE count haircut at all. So. Yeah.
Fantastic. So one I'll quickly answer is one asked, how many PPP loans can we get? The answer is 1 per EIN. And then the next one kind of goes into a little bit kind of similar to the EIDL, the grant versus the loan. People are asking about the taxability of the EIDL loan for federal California, and I assume probably also the California related for PPP and EIDL, the forgiveness portion, kind of the distinctions there.
Yeah, like I said before, the only forgivable loan that we think is not taxable, what we know is not taxable, is the PPP that's forgiven. And the question is whether the deductions are suddenly vanish as well associated with the forgiveness, as opposed to all these other grants that, to my knowledge, none of them are tax-free. But if they allowed you to pay expenses, presumably, you're net no worse off from a tax standpoint than, the only one time you would be is if you got to keep the grant money without spending it on expenses, then clearly you're ahead and you're going to pay taxes on that grant is my understanding. So, and there is quite a bit of chatter about the fact that people are getting grants that didn't necessarily need them, and they're getting publicity. And that's just probably not a great place to be in general, if that's the situation. You know, they probably are going to worry about it depending on, if we had to guess, depending on how much we're talking about, and who you are and that kind of thing. But yeah, there'll be more on that. Yeah.
Oh, absolutely. A good one related here is just kind of a quick one. I think there's an easy answer to it, but is the interest on the EIDL loan, or also if there was an unforgiven portion of PPP loan, is that interest tax deductible?
Yes. Yes.
So just as any other business loan.
Mm-hmm.
So one had a question about the employee retention tax credit. Is there, and I'm not sure I understand the question, but we'll see if you can piece it out. Is there a way that any of the deferred taxes will be forgivable? I'm not sure I understand that question either. It looks like your faces don't either. So.
You know, I think I think I understand the question. So
okay.
The tax credit reduces your payroll tax expense. And in fact, in theory, because you get up to $5,000 per employee, could actually become net income. I believe that will be taxable income if you actually run through all your payroll tax expense via these credits. It's actually impossible because you can only get up to 50% of up to $10,000 worth of wage. So, but it could actually be more credit than you have, say, payroll tax expense, for like the employer share. That's going to be taxable, we believe. There's no provision to make that not income.
Cool. And then someone asked, just to clarify, what FTE is.
Oh, full-time employee equivalent. Full-time employee equivalent. Yes.
Yeah.
Which is 40 hours per week.
Yep. And so the simple math that I always tell people is you take, like, let's say you have 5 part-time employees, you add up their total hours, you divide it for a week, you divide that by 40, and that's your FTE count.
Yeah, there is an alternative where you have employees that actually work less than, you could choose this other method if they work less than half time, and call them and just give every part-time employee half of an employee. So you would only do that if you employed enough people working less than half time to counteract the ones that work more than half time. In other words, you can pick your better method under that theory. Right.
And where I always recommend people is Society for Human Resources Management has some great explainers and great calculators.
Yeah.
And so next person someone had was, can you explain the owner-employee category that you talked about earlier?
I wish we could, right, Trina?
Yeah.
So that's the one glaring missing answer is, what is an owner-employee? The example that they give is a sole proprietor, which is pretty clearly an owner-employee. They own 100% of the business. But beyond that, we don't know if a little 0.5% employee owner constitutes an employee owner. So the way we've been advising is that assume it does, for purposes of all these FTE counts and other criteria, and then we hope to hear from the SBA once and for all, how are you defining that? There's a lot of stuff out there like, well, they're probably not going to look at anybody under 20%. That's out there, but it's all just speculation.
Yeah, good, because there are a bunch of questions on that, because I know it is confusing as well, and we're waiting on some additional clarification on that. So let's see here. So yeah, so certifying the owner employee, if they only get 850 seconds or basically 8 of the 52 weeks. So I guess this is it. So yeah, so if we paid the maximum amount of the 15,835, so part of that's not forgivable, I guess is kind of some of their question kind of related to that, but I think you somewhat answered that.
For the 8 weeks, the limitations are the same for regular employees versus owner employees. But when it really comes into play is if you choose the 24-week period, because regular employees get up to, I think it's like 46,000 is the limitation rather than the 15,385 for the 8 weeks. But owner employees are limited to 2.5 months only. And so that's where that owner employee distinction really comes into play, because owner employees are limited to about 21,000, where regular employees can get up to 46,000.
Okay, thank you. So again, there's still some questions we have coming through, so maybe we'll just kind of cover that one more time, kind of the distinction between the loan portion and the grant portion, what's taxable and what's not, and kind of the reason why.
Yeah, that to our knowledge, none of the the advances that were grants, essentially not having to be repaid, those are not tax. That is not a tax-free event. When you get that money, it's just income. It wouldn't go on as a loan. It was never a loan. It's just income, essentially a reimbursed expense that reduces your overall losses or increases income. And the only one that has what we believe is a true tax-free element with a tax savings attached to it is the PPP that's forgiven. We think we all know that's not a taxable event because it says that specifically in the bill. What they didn't cover in the bill was, well, what about the expenses associated with that income? It's assumed that Congress intended them to be deductible and that they wanted to give a tax benefit to those businesses as part of the stimulus. But the IRS has gone the other direction with this notice, and we believe there are several congressmen that want that fixed, meaning so that it is a tax break. And we're hoping that this next stimulus bill addresses it. They tried to address it the way that we expect them to address it in the last stimulus package that died when it went to the Senate. I don't know if people are following the politics around this, but it died a couple of months ago, and that was part of the package actually. And then it all went away, and they're negotiating a whole new deal, and which we believe will come out soon.
Yeah, and just to add on to that, the EIDL loan portion or any of the PPP loan piece, any of the piece that isn't forgiven and becomes a loan, there's no taxable income that comes from those. Those will just be treated as a loan the way any regular loan would be. So you don't have to pick any of that up as income.
That's right.
And then, because this is, so then the kind of the clarification, that I see someone kind of asking. So then so the wages that I've paid, so assuming your interpretation continues and this fix happens with the IRS with the way the CARES Act is written, then how are those, the payroll that I've paid my employees handled in terms of the deduction of my business expense? Is that just a deduction in addition to?
Yeah, not to get too compliance focused here, but when Trina and I prepare a corporate tax return or an LLC tax return, we have we figure out the net income, the bottom line, if you will, based on how anybody would look at it from a financial point of view. But then there's all these book to tax differences that occur. An example is they don't allow us to deduct more than 50% of our business meals. So that ends up being an add back onto the schedule that we reconcile between book and tax income. It's called Schedule M1 or M3, depending on the size of the business. Anyway, I envision that if this is corrected, that we would have an M1 for adjustment for every single forgiven PPP loan, meaning this will be income on my books that I do not have to include on my return for tax purposes. And it'll create that subtraction from income so that my taxable income is lower than my economic income just because they are giving me a break here. That's how I would envision this would work.
Assuming we get the fix.
All right, so here's another one. So I think this might be after someone's PPP runs out, and then they're now using their idle for payroll, particular owner withdrawals for sole proprietor. The question is, does the payroll amount also have to be based on 2019 net income, the same as PPP payroll, or can it be higher?
No, it can be higher. There are no rules around, if you qualified for the idle, the only thing you had to demonstrate was your economic injury when you applied. If that was there, that's just a regular loan, do whatever you want with the money kind of a thing. The only thing if you have both the idle and the PPP that they made clear is don't try to pay the same expenses with both amounts. First of all, you couldn't, right? Really, but that will screw up your forgiveness, is what they're saying. So,
right, and yeah, that's super important. Don't use them for the same purpose. And it obviously, like you said, you can't. But but the key is idle, with the exception of the advance, is a loan that has to be repaid. Even if you're paying yourself or anything like that, it's a loan that has to be repaid.
yes.
And I think that's something super important. So that's pretty much the questions. I know we've got a couple of minutes here. What are some of the frequent issues you all are seeing or questions in terms of PPP forgiveness, or things that are kind of tripping people up based on the rules that we know as of today?
Well, I did just see one flash up that's interesting, and I think the participant is correct. That you can't use the idle monies or the PPP monies to make loans to owners. I mean, just just practical. Yeah.
Correct. So
go ahead, Trina. You've been heavy involved in helping clients get ready for their forgiveness application.
Yeah, I think like we already discussed, the owner-employee issue is one of the biggest ones, because at least for a lot of my clients, and I think Bruce's clients too, a lot of these businesses have minority shareholders. So maybe they own 2% or 1% of the business. And does that need to be considered an owner-employee? Like we kind of already discussed, we are taking the conservative approach right now, just in case, because we'd rather, take that conservative approach now, so that if they do change the rules, you don't have any big hit on your forgiveness application. A lot of other ones surround bonuses, commissions, severance pay if an employee is terminated. There really isn't guidance per se on how to account for these. I do think with all of these items, you have to, I think commissions specifically, you have to kind of be aware of that 75% rule that Bruce brought up earlier. If you're paying an employee less than 75% of what they were paid during the testing period, then you can have an additional haircut to your forgiveness. So if, during the 2019 testing period, there were these huge commissions that employees were getting, and now during 2020, there's just not as much sales, or the commission structure changed, or however that may be. If there's a huge swing in those commissions, it can impact the overall payroll and put employees less than that 75%. Bonuses and severances, I think, are kind of one of those hard ones, because they apply to periods that they aren't necessarily paid in. Bruce, have you really seen any specific guidance that says how to apply these? I mean, I know that we've had discussions around how to do it, but I haven't seen, I don't think, any specific guidance that says how to apply these items.
No, not on the kind of the extraordinary payment piece.
Yeah.
And so again, we always go whenever we don't know, our advice is let's assume the worst.
Yeah.
And approach it that way, and then hope for better news. We did get one piece of good news. You want to get into that as far as what we believe to be the case in terms of, the amount of the loan not being a ceiling as far
For
as
the FTE one?
Yeah.
Yeah, so the way that originally what we believed is when you apply the FTE reduction, it is capped at the amount of the loan. So say you get a $100,000 loan and your FTE reduction percentage is, let's just say 90%. So originally the way that we had interpreted this is you would take that $100,000 loan as the cap and apply this 90%, and only $90,000 of this loan would be eligible for forgiveness. But the way that the forgiveness application actually reads currently, and hopefully there isn't any guidance that comes out that disagrees with this, but the way that it currently reads is you can actually have eligible expenses that are larger than your loan. So say you had during the covered period $120,000 of eligible payroll expenses, just to keep it clean, just say it's all payroll. You actually apply that 90% FTE reduction against the 120 expenses that you had eligible during the covered period. So in many cases, this can be higher than the actual loan amount, and then it won't actually reduce the forgiveness of your loan if your reduction isn't too big. So after you would apply the 90% to that 120, and then at the end, you apply the limitation of the smaller of the loan, or that 120 times 90%. So this can be really good news, assuming, like I said, they don't come out and change this, which we really hope not. But if you have those eligible expenses that are higher than your loan amount, you may be able to actually kind of get around that FTE reduction piece.
Cool. So there was one good question that came in that in terms, again, for self-employed. So you get your PPP, you have that forgiven portion. So she's saying it should not be reflected on Schedule C. Is that correct?
That's right. If we don't have a problem with this IRS notice, in terms of the expense, it's self-employed is kind of a weird concept, right? Because essentially your payroll is your net self-employment income haircut by 7.65% for the deduction of the self-employment tax. So 0.9235 times your net income from earnings from self-employment is your payroll. And so that's the number that could be forgiven. That's the number that generated the loan, and times the 2.5 months. And so and again, if they're going to say that the expense is not deductible, then I guess in theory, even though this isn't really an expense, it's just your net earnings from self-employment, that would make it taxable in theory from that IRS notice. I don't think they have thought that through, to be honest, because it's, first of all, the whole comment, the whole premise is different than it is for a regular W-2 employee, where it's kind of easy to say, okay, well, this is their wage, and you don't get to deduct that wage because we forgave some of your loan under that. That's easier to interpret than this weird one for self-employment, where you don't really even have an expense. You just have the net earnings of that business. Basically when you pull out of your self-employment income from business, it's just considered a draw from a tax reporting point of view, it's not a deduction anywhere. So I know I get one common question for self-employed is, how do I pay myself, you know, from my income to make sure I get my forgiveness? And it's like, you don't. It's your net income from self-employment is the basis of all the loan and the forgiveness times this 9.92.35. It couldn't be more complicated, right? But that's what the reality is. Cutting yourself a check from your bank account doesn't do anything for you if you're self-employed, as far as any of this PPP stuff goes.
Exactly. Exactly. And I think, oh, am I on mute? Did I lose? Here. Oh,
Can't hear you. Oh, wait.
can you hear me now? There we go. Apparently my headphones died. All right. Well, our time's up, and I do, you know, so in terms of some of the PPP, that's what us at the Small Business Development Center, we're digging deep into that. We're in constant contact with the SBA and the U.S. Treasury and staying up to date on that. And so, you know, for all of this, that's what we're here for. You can visit our website, sdivsbdc.org, or you know, that's where you were able to register, or you can email where you got the Zoom link, and we'll be able to get you in contact with an advisor to kind of help you through a lot of that. But I really want to thank Tarina and Bruce and Moss Adams. This was fantastic information. We know that this is, as we all are saying, very fluid. And this is the information that we know as of today, June 22nd at 10 in the morning. And because everything is continuously changing with this. And we know that there's probably going to be more rules, more interpretations, more laws, but it's good to at least start framing a lot of the stuff that we're looking at. And we really, really appreciate your knowledge, your expertise. And so again, thank you very, very much to the two of you and to Moss Adams for all of this. We really appreciate it. So
thank you.
All have a fantastic day. Everyone stay safe. There you can see again, thanks Tarina for bringing that up, Bruce and Tarina's contact information. And again, really, really appreciate everything that they have. I will be emailing out a recording of this webinar to everybody who did register. So thanks all.
Thanks, Danny.
Yeah, thanks, Danny.
Thank you. Bye-bye.
Bye-bye.